Palantir. Shares are up 45% this week, which, given how much it makes up of the S&P, might be part of the reason it's higher, but it's actually not that much of the overall index just at the moment, although the way it's going, it will get there pretty soon. They released earnings. I thought their earnings were I was saying to Steve beforehand, I thought their earnings were very, very good, and I thought their general progress report was very, very good. It's a mighty expensive stock, though, and there's a real question as to whether you think it was overvalued before. I can sort of see in my head that if you really didn't care about valuation the first time and you thought the business was good enough for anything, well, maybe you still feel that way. I'm not sure why this would change anyone's mind, why anyone suddenly draws the line, at this point and says, no, at that point we're going down. But see what you think. So total revenues are up 36%, 64% growth came from their commercial, US commercial business, where they've been effectively supplying their solutions to everything from bottled water to ag tech to medical device companies. They managed 64% revenue growth in that part of the business. It's worth noting, I think, for the growth enthusiasts about this, and I'm quite convinced by Palantir, to be honest, that 64% growth in that commercial sector, plus some decent growth from the government division, which is just over half of their business at the moment, still translates to only 36% overall revenue growth. Their customer count in that part of the business is up 73%. They managed 188 new deals, and operating income was up 26%. They've also had some fairly strong results on their government side, although that grows kind of slightly less quickly and makes up more of the business. They've extended some partnerships with the army, and they're still kind of heavily winning government contracts fairly well. Total contract value is currently 803 million. They're trading at a price earnings ratio of 600. Their guide for both the next quarter and the next year, I think it looks very, very good. They're looking for 33% revenue growth in the next quarter. This is sort of year over year, not compared to the quarter just gone. So Q1 to Q1, guiding for 33% revenue growth with 54% growth in their commercial arm. 3.7 billion, over the year that's set to be. And they're looking to roughly 4x their operating income next year, which take them to 1.57 million. And that's a pretty 1.57 billion. And that's firstly some pretty impressive margins. Secondly, some pretty impressive growth. There is a large but about this, and in that 1.57 billion, which is your adjusted operating income, and I think their adjustments are not unreasonable necessarily. 691 billion this year went back out again on stock-based comp. We always care about this. We sometimes do and sometimes don't think it's decisive. And you may or may not think it's decisive this time, but it looks like around half of your operating income is going to go back out again as stock-based comp next year, unless they find a way to bring that down. Could be that they're going to do the Amazon thing, and you saw that actually coming down quite a bit. We'll talk about that further down the line. But I was trying to work out what I think of this in kind of valuation terms. And my honest answer in terms of, do I think anyone's crazy to buy it? Not am I going to, but do I think anyone else is mad to, is this really depends on time horizon, in my view. I think if you're looking at a 10-year investment with this, with bond yields at 4.5%, the earnings yield on this is so low that I don't see that it can grow fast enough to offset that in 10 years. Over 30 years, with an average yield of 4.89%, I could probably see that as being, you could work out that story to make that work from here with the way this is growing, the way it's signing up customers. They get in, they can't seem to get enough of it, and I think there'll be plenty of room for shifting the price higher. I can't see a meaningful competitor on the horizon for them, and nor can they. That said, I couldn't see one when DeepSeek arrived either, so you should take me as not being a particular AI authority on this. I don't see myself buying this. I am very impressed by this business, though. Steve, what do you think?
It's a sort of report of two halves, really. It was like how good the US revenue is doing and how not so well the international revenue is doing. US revenue was up about 52%, but international revenue was only up about 3%. But they're the negatives. I mean, get them out the way, and you've got business metrics here of remaining deal value, about 5.43 billion. That looks like that's up about 40%. Total contract value up 56%. US commercial remaining deal value up 99%. Commercial total contract value in US up 134%. About 1.73 billion in remaining performance obligations. And then there's obviously short-term, and they're breaking out short-term and long-term for you, but that's up 30 and 50%, 29% up billings. Just did a Rule of 40 calc while he was working on that, Steve. It's 81. So it's pretty high above that. Retention growing as well. It was 118%, it's now 120%. And just for people at home who don't usually use retention as a metric, that means that every year, essentially, if your retention is above 100, you retain the revenue from the year before. If it's 120, it means that you essentially get all of the revenue from the year before, plus your own customers you already have spend 20% more with you. So that is pretty impressive. One of the things we were worried about when we originally looked at this, we were like, look, you're paying, even before when it was like 40, 50 billion market cap, you're only getting sort of 15, 20% growth. That's no longer the case. That's essentially doubled. Revenue is at 828 million in the quarter, up 36%. That's pretty impressive inflection in growth. But I've got to go back to your point, Steve, and just say, look, this is now a $257 billion company. On what we have here and what we know, there's a hell of a lot priced in here. And what you don't want to be is, the old adage of the cinema where people are going into when you fill up a cinema, not everybody turns up at the same time. The people drift in, while the adverts are on and get ready to see the film. But when when the fire alarm goes off, everybody's going to be crowding at the exit to get out of those, maybe one or two small doors. And I have a feeling that that'll be the thing with Palantir. That's not to say we're at the top, Steve. This could go on forever. This could go on, not forever, but this could go on for, a couple of years yet, before people start to think, well, this is getting a bit heady. But yeah, you're right. I don't see much in terms of competition. Quite impressive how they've been able to make this company into what it is today. And I like you, Steve. I mean, hats off to everybody who's had it from 8 or 10 or whatever it was. They've done incredibly well. I don't think I'll be in a massive rush to add this one to my portfolio, Steve.
No, my feeling is their story has changed quite a bit from 8 and 10 and so on. I mean, back when it was 8 and 10 and IPO'd and so on, it was an interesting kind of defense or US government kind of piece of kit and pretty good by all accounts, but and important as well. But there is only one US government, and there's only so much money you can kind of get from that. I mean, quite a lot, but there's a limit on this. Now that you can start taking this out to various different companies in various different industries, that raises it feels very 2020 to be talking about a total addressable market, but look, we're talking about something at nearly 90 times sales, so we've got to find something to try and peg it to here. That changes things quite a bit, I think, and congratulations, to anyone that's been holding it since at or near the beginning. I'm very impressed by the way this thing has gone. The competitive thing bothers me. It bothers me just a bit. I can't see anyone getting close, but then I wouldn't be able to see anyone getting close, which is why this sort of goes on to the too hard pile, even though I feel more confident with this than I do with something like Tesla, actually. And that might be a slightly weird thing to think, because in the realm of expensive stocks, this is actually higher than the electric car, not a car company right now. But I am much more impressed, I think, probably because I think they have more clearly working tech in this situation. They have a product that works, and people just cannot seem to get enough of it. They were saying they're getting a lot of kind of push from marketing at the moment as just the word gets out and people hear and find out about what their stuff can do in terms of optimizing things. I saw their slides feature a kind of Rio Tinto train scheduling thing, which seems like a fairly minor bit of stuff here, but it shows up everywhere and it matters everywhere, and companies are well impressed by what they can do. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.